All right, let's talk about something that's on a lot of people's minds: buying a house. It feels like the dream of home ownership is slipping away for so many of us. But there's a new, pretty controversial idea floating around that's supposed to help: the 50-year mortgage.
But here's the million-dollar question, right? Is this a clever fix that's going to get more people into homes? Or is it a financial time bomb just waiting to go off? That's what we're going to unpack today, looking at all the angles. So let's get into it.
So, first things first, let's just be real about the situation. Buying a home in America right now, it's tough. I mean, for a huge chunk of the population, you run the numbers and they just don't work. That dream feels more and more like, well, just a dream. And look, this isn't a simple issue with an easy answer. It's a total perfect storm. You've got wages that just haven't kept up with these skyrocketing home prices. Then there's the fact that there just aren't enough houses for sale to begin with. And on top of that, building new homes is really, really difficult. It's a mess.
Okay, so in the face of all that, the Trump administration has floated this new idea to try and tackle at least the money side of the problem: the 50-year mortgage. Now, this would be a massive change from the 30-year loan that's been the gold standard for decades.
Before we go any further, we gotta talk about a key term here: amortization. It sounds complicated, but it's not. It's just the fancy word for how you pay off a loan over time. Every single payment you make gets split into two buckets. One part pays down the actual loan, that's the principal, and the other part pays the interest you owe the bank.
And this is where you really see the trade-off. It's the classic give and take. With a 50-year loan, your monthly payment is lower. That's the big selling point. But, and this is a huge but, you end up paying way, way more in interest over the life of the loan. We're talking potentially double. And the other thing, your equity, the part of the house you actually own, grows at a snail's pace, especially in those early years.
Okay, so keeping that trade-off in mind, let's look at the argument for this whole idea. Why are some people looking at this and saying, you know what, this could be a game changer for buyers? It really all boils down to one simple, powerful thing: lower monthly payments. By stretching that loan out over 50 years instead of 30, that monthly bill shrinks. And in theory, that means more people could actually get approved for a loan and finally afford to buy a home. And you can hear this perspective from people in the business, like broker Holly Brink. She's not seeing this as some kind of trap. She's seeing it as another tool in the toolbox, something that gives buyers a fighting chance to win in what is an incredibly competitive market right now. All right, but for every action, there's a reaction, right? And a lot of financial experts and mortgage pros are hearing this idea and throwing up some serious red flags. They see it less as a helpful tool and more as a potential trap. So the critics are basically pointing to three huge issues here. First, that absolutely staggering amount of extra interest you'd pay. Second, you'd build equity, your actual wealth, so incredibly slowly. And third, and this is interesting, it could actually slow down the entire real estate market. And this is a really crucial point because it's not just about your wallet. Broker Josh Rees explains it perfectly. If people aren't building equity, they're stuck. They can't afford to sell and move up. And that creates a logjam in the market for everybody else. Fewer homes for sale, longer waits. It's a ripple effect. So let's pull back for a second and look at the bigger picture here. Because honestly, whether you love the 50-year mortgage idea or you hate it, pretty much everyone agrees it's kind of like putting a Band-Aid on a much, much bigger wound. The truth is, this affordability crisis didn't just pop up overnight. We're talking about decades of wages just not keeping up with costs. We had that insane surge in demand for houses during the pandemic, and all of this is built on a chronic, long-term shortage of available homes. A new type of loan doesn't build more houses, and it doesn't give everyone a raise. And I think this thought from Daryl Davis really hits the nail on the head. We absolutely need new ideas. The industry has to evolve. But if we rush into things without being super careful, we could end up creating brand new problems, even bigger ones down the road.
So, where does that leave us? After digging into the mechanics, the pros, the cons, we're right back at that huge question about what the future of buying a home is even supposed to look like.
When you boil it all down, it's this. On one side, you have the fix, the idea that lower monthly payments could open the door to homeownership for more people. But on the other side, you've got the time bomb, the risk that you're just trapping those same people in a half-century of debt, making it almost impossible to build wealth and costing them a small fortune along the way. And that's the big question I want to leave you with. Is the answer really just to stretch our debt out longer and longer over 50 years? Or is this whole debate a wake-up call that we need to stop tinkering with the financing and start tackling the huge fundamental problems that created this housing crisis in the first place?